This is Barry Zalma speaking for Claim School, Inc. with another true crime story of insurance fraud. This number 30 is about the mortgagee who decided to commit insurance fraud. As insurance companies become more sophisticated in the tools needed to defeat insurance fraud, the frauds become more complex. Those who earn a dishonest living stealing from insurance companies find that the simple, straightforward fraud is no longer successful. They have become insurance scholars to learn better ways to steal from insurance companies. The 1942 banking industry wrote a document known as the Standard or Union Mortgage Clause, Form 438 BF-UNS, to protect mortgage holders from dishonest borrowers. The banks were concerned because occasionally their borrowers committed arson and the insurers refused to pay. The policy was declared void as a result of the arson and resulting fraud, and neither the insured nor the mortgagee recovered. As a condition of allowing their borrowers to buy insurance from particular companies, the banks insisted that the companies attach to their policies a union mortgage clause. The clause provided that if the borrower, by act or omission, caused the policy to be void, it would only be void as to the interest of the borrower and not the lender. Therefore, even if an insurer proved that its insured burned the building down, it still was required to pay the mortgagee its interest. The contract between the mortgagee and the insurer was found to be a separate and distinct policy. The insurer could only defeat it if the mortgagee had knowledge of an increase of hazard. The Union Mortgage Clause gave security to honest and reputable lenders. It also gave a dishonest lender the means to commit an arson for profit without the possibility of loss or criminal prosecution. The fraud would work with the insurance criminal first buying a distressed dwelling at a foreclosure sale for less than its true value. With a co-conspirator, the mortgagee would arrange a mortgage on the dwelling for 3 times the amount paid. He would then buy a homeowner's policy from an unsuspecting insurer, naming the mortgagee under a standard or union mortgage clause. Before the first installment was due on the premium financing, the dwelling would burn to the ground. Gasoline would be found on the premises, and the local fire arson unit would conclude that the fire was intentionally set. The building would be vacant and without contents. The named insured, the alleged borrower who had used a fictitious name in the purchase of the insurance, would disappear. He would not even give notice of the claim. The lender would submit a proof of loss claiming that its entire interest was destroyed. It would also make a claim for the full policy limits, providing a copy of the mortgage instruments to establish its claim. The insurer, convinced that the insured set fire to the dwelling and unable to reach him, would be thankful that it had no contents or additional living expenses to pay. It would write the named insured at his last known address, denying his claim for failure to cooperate. The insurer would then pay the mortgagee's claim in full. Usually, the insurer, not wishing to get into the mortgage business, would not even request an assignment of the mortgage debt. The lender, paid more than the original price for the fire damage to the dwelling, would issue a notice of foreclosure and sell the real property, what was left, at a foreclosure sale as an empty lot. The original named insured would share half the proceeds of the insurance policy with the mortgagee and would also receive 50% of the monies received from the foreclosure sale of the empty lot. The insurer, with no way of proving the conspiracy, would close its file. The insurer believed an arsonist had not succeeded in his crime. The insurer had no choice but to pay the innocent mortgagee. This type of fraud continues. Unscrupulous lenders invest their profits in distressed properties, both residential and commercial. The losses they report are not always fire. Some more imaginative insurance criminals use the vandalism coverage to provide a more profitable fraud. First, they avoid the hazard of physical injury with setting an arson fire. They also avoid arrest if accidentally seen committing the arson. Second, by judiciously vandalizing the structure, the mortgagee and the named insured find that they can have a distressed property totally remodeled and restored at no cost to them. The borrower, shortly after taking possession, would take a 3-pound sledgehammer and punch a single hole in every sheet of drywall in every room, a single hole in every cabinet door, a single hole in every passageway door, breaks each porcelain fixture in the baths, break the lock, and put a single hole in the front and rear entry door. He would also dent or damage the central heating system and cut jagged slashes through the carpeting. The borrower and named insured would then disappear, since the entire transaction was a sham with fake names and identification. The mortgagee, claiming discovery of the damage on an inspection trip to decide why the payments had not been made, would report a vandalism claim. The mortgagee, knowledgeable about insurance, would have records showing that the premises were occupied less than 30 days before the discovery of the vandalism. The insurer, in good faith, would agree to a scope of damage requiring the replacement of all of the drywall, the repainting of all the rooms, the replacement of the carpet and all of the plumbing, furnishings, and fixtures. The mortgagee would agree to an actual cash value settlement. Then, using its own employed workmen, the mortgagee would repair the drywall with patching plaster, caulk fixtures, and for 1/10 of the cost of a reconstruction contractor would totally remodel the house. The mortgagee would then conduct a foreclosure sale and sell the remodeled house. The mortgagee would profit by both the receipt of the cost of repairs and the profit on the sale of the now remodeled and restored house. The mortgagee and the borrower would split the proceeds equally and start the cycle over with a new house. To defeat this type of insurance fraud, an adjuster must be professional, vigilant, thorough, and exceedingly lucky. This video was adapted from my book, Insurance Fraud Costs Everyone, which is available as both a Kindle book and a paperback from Amazon.com. Thank you for your attention.